So let's break down today's market action. We have Lance Roberts. He's from STA Wealth Management, CEO. He says that the bull market has run its course. He's going to tell you the best way to hedge the risk in case of a correction. And Larry Shover joining us from the CME. Larry, I want to start with you. The fourth day, as I said, is the charm. We were kind of worried 3 days in a row down in the first 3 days of 2014. What turned it around today?
Hard to say. We've had a good and fitting attitude adjustment. After days of doom and dread and dithering and drama, it suddenly has just given way to a market that we've seen many times in 2013 with broad participation among all different asset classes. We've also seen not many shorts being laid out in the market, and any kind of weakness we've seen today has been met with very good demand support. Nobody seems to know. It just seems like that drama has run its course, and we're back to market or business as usual.
Lance Roberts, how many times have we said this market has reached its peak? It's time for the pullback, ain't going further, and then what happens? Lo and behold, the next day it goes up again. How many times has that happened?
Well, it's happened a lot last year. That's kind of one of the things I was talking about for this year, for 2014, is, last year we didn't really have a correction of any magnitude at all, which is highly unusual. So it's very likely that sometime this year, we're in a midterm election year, which normally sees 10 to 15% corrections in the second to third quarter. We could very well see something like this year completely normal, which would give you an opportunity to put more money to work at a better valuation level.
Well, talk about money. Do you still suggest everybody sell everything right now and go in cash?
Oh, no. Yeah, no. And I would never recommend that at all. As we've talked about before here, David, you and I in particular, we've talked about, pruning the garden, being a little bit prudent, taking some profits out of your winners, trimming off the losers and the laggards. And that's always just a good risk management. And then that gives you some cash to buy stuff when things are cheap. Remember, we're supposed to buy on dips and sell on rallies, not vice versa.
Right. Well, Larry, what is it about the markets right now? They seem to be waiting for some clear signal, whether that signal is a jobs report on Friday. Tomorrow we get the minutes from the Fed's last meeting. What is it? Their earnings season, that's coming out in a couple of weeks. What is the market looking for right now?
I think it's a combination of all of them, and add the ECB as well. But most importantly, it's got the Fed minutes tomorrow. As we know, most of these Fed minutes have proven to be semi-hawkish, or you could decipher them to be hawkish. But that aside, I think the market's comfortable with the fact that we are going to continue to taper, probably going to be end tapering by November of 2014. It's going to be interesting to see the appetite the market has for any kind of extracurricular talk with regards to changing the threshold for unemployment or inflation floor or the excess reserve interest rate cut. That's what we have to look at. That's what the market's waiting to see what's going to happen. I'm shocked, actually, that we're as high up and as strong as we are today, given all those moving parts that we're going to see tomorrow. But so be it.
Well, and Lance, we don't have to wait till tomorrow. Yeah. Today, we heard from the San Francisco Fed President, John Williams. He's saying all of the tapering will be done by 2014. That is, within this year, we will see the end of this extraordinary bond purchasing program of the Fed. Do you believe that?
Well, it depends a lot on how the economy and the markets really react to.
Well, to be fair, hold on a second. Just to be fair, excuse me, just to be fair to John Williams, he said the same thing. He said if the economy continues to improve, we'll see the end of the tapering for this year. Go ahead.
And I think that's exactly right. If we see a retracement on employment, if we see a big stock market correction, the markets have really have liked this liquidity push. And if we begin to extract that and the markets are not able to deal with that, I think we'll see the Fed stay in longer than expected. As long as things kind of stay on the current trend, it's very possible we'll see that. But if you look at personal consumption expenditures, they're on a decline on an annualized basis. Retail sales are declining on an annualized basis. And fixed investment really follows those two trends very closely. So if we don't see those pick up, it's going to be hard for the economy to get the traction necessary to get the Fed out of the way.
By the way, another thing on the decline, Lance, is emerging markets. They've been hit much harder by taper talk than our markets have. Have they reached a bottom yet, or do they have more to fall?
No, see, and I think that's the interesting thing. I think that if we get a correction sometime later this summer, we'll see some of the real hated sectors of the market really play in. Staples and utilities, fixed income, and emerging markets, as well as gold miners, are oversold enough to where we could see a good counter-trend rally sometime this year in those assets.
Well, Staples, you have some specific stocks. You're talking about P&G,
Sure.
Procter & Gamble, Coca-Cola, PPG Industries.
Right.
What makes you say they've been oversold? I still see their record for the year 2013 as being pretty impressive.
Yeah, no, it really is. But if you look at the utility sector and Procter & Gamble and Coke and those type of companies, you know, they're strong dividend yielders, and they're going to catch money flows. If the market gets spooked for any reason this year, money's going to flow out of technology stocks like Twitter, Netflix, and the like that are these excessively high valuations, and they're going to look for companies with good, strong dividend growth, good, strong fundamentals, and that's why I like those old, boring companies. They're great hedges against market volatility.
By the way, very quickly, Lance, you see the pullback coming.
Yes.
When? Timing is everything. When do you see it coming?
This summer.
This summer. So hang on until
Yeah.
then. All right, we got to leave it at
you'll be
that.
fine till then.
Lance Roberts, Larry Shover, thank you, gentlemen. Good to see you both. Stay warm.
Thank you.